Hello guys, welcome to another TV video. Today taking an in-depth look at the Walt Disney Company, commonly referred to as simply Disney, an American multinational mass media and entertainment conglomerate headquartered at Walt Disney Studios complex in Burbank, California. As of the 5th of February 2025, the stock was priced at $113 with a market cap of 204 billion. Their forward price to earnings is 23.7 compared to their median 10-year price to earnings of 22.4. Their price to cash flow is 14.6 and their forward dividend yield is 0.88%. Their revenue has increased by 39.7% in the past 5 years. Their net income has increased from negative 3 billion to positive 5 billion. Their earnings per share have also grown from negative 2 to plus 2.4. The common shares outstanding have increased by 1.3%, so a very small dilution. Now let's look at their liquidity and solvency. We can see that their interest coverage ratio is 47.21, which is really good, suggesting that they can easily cover their interest payments. Their quick ratio is 0.61, suggesting a moderate ability to handle short-term liquidity shocks. And the long-term debt to equity ratio is 0.47, and their debt to equity ratio is 0.43, both suggesting a moderate debt load. Cash from operations has increased from negative 2.5 billion to positive 4.5 billion. Their cash from investing has increased from a negative 3.5 billion to negative 7 billion, so 89% increase. The cash from financing has decreased from positive 8 billion to negative 15 billion, and the capex has increased by 34.6%. Most important of all, free cash flow has increased by 138.2% in the past 5 years. And now let's move on to the financial ratios. We can see the return on equity is 9%, sorry. Return on investments is 5.7%, return on assets is 4.5%, return on invested capital is 5%. I used a DCF, multiples, valuation, and analyst expectations to find the intrinsic value. You can see on the in the video what multiples I used, what discount rate I used for the DCF, and so on and so forth. And calculating the average of all three, I got an intrinsic value of $110.24 compared to a current price of $113. Applying a 50% margin of safety, you get an acceptable bar price of $93.7. Suggesting that a stock at the current levels is trading near intrinsic value, but too much above their acceptable buy price. Now, to conclude, I believe that Disney is a good company in terms of balance sheet, but a horrible company in terms of management. And you'll say, what? How can I say that? How? Well, if I if I would have put the chart in the past, sorry, 10 years, not 5 years, in the past 10 years, you would have seen that they basically haven't grown at all. All of this growth is actually just recovery from COVID. They haven't grown at all. And any real growth that will be happening until the 2030s, into 2030, is basically growth that is accounting for the inflation that destroyed their actual growth. So if, for example, they increased from the COVID lows to their pre-COVID levels, now accounting for inflation, they actually still have to increase even further to account for pre-COVID levels if you take inflation into account. So and also you have to actually give a not on top of this increase, you actually have to increase even more because you have to give shareholders their return. Uh, most um, most of the value investors I've seen on YouTube know that Disney is not that great of a company because you could see their stock price chart value maybe in the medium term of 1 to 2 years not reflected, but you can clearly see on Disney that their stock price chart shows their value is non-existent. There is nothing to see here. This is just a company that has been recovering from COVID. And actually, let me go back to show you what I mean more clearly. You can see that free cash flow is going to stagnate in the next years. All of this has just been a recovery. There is nothing to see here. And if you actually go even more back to their net income, you can see that this is just a recovery. So this 10 billion here, this is a 24, the price to earnings which I've shown is calculated on this. And if they increase, continue to increase at 6 or 7%, I think something like that would be okay. Then you have to think about the fact that Google, another company trading at the same price to earnings, has a much better balance sheet. They're trading at literally the same valuation. Actually, I think Google is trading at better price to cash flow, price to free cash flow valuation, if I remember correctly, and they're growing much more. So I think you have better opportunities out there in the market. Of course, I know Google has huge regulatory risk, but I don't think Trump wants to break up Google. Uh, I think he'll just make the problem go away. But as I've said, there are better opportunities out there in the market. And this is just a recovery play, to be honest. I mean, Disney has already recovered. As you can see, the revenues, where can you see growth? I mean, yeah, sure, this is recovery. But other than this, I mean, what the fuck is this? 5% growth, 6% here per year. So nothing to see here, to be honest. And if you include the 3% inflation rate, so that you're getting 2 to 3% return on your investment if you include inflation. This is much worse than any other opportunity out there in the market. And I believe that you should do your own due diligence, but I don't think there's something to see here. Unless we go, I don't know, to $90 stock price, 90 or not 85. Yeah, I think that would be great. But yeah, I just don't see the opportunity here. Correct me if I'm wrong in the comments, but yeah, and also I don't forget I did the DCF with 7% CAGR for 10 years. That also inflated their operating cash flow margins and deflated their capex margins. So they're actually increasing their free cash flow a lot in my DCF, which isn't happening in real life. So yeah, they're already calculated on pretty overvalued, on a pretty optimistic, sorry, DCF. Yeah, this has been it for today. Also, do not forget to check out my affiliate, Ticker Data. Ticker Data is a great tool for Excel where you can use ticker data as a sort of API, I think that's the word, for Excel, where you get real-time financial data, and you also can go on their website and download some interesting templates for a DCF, DDM, bank valuation, so on and so forth. Yeah, it's a great tool. It's also pretty cheap. I suggest to check it out. Also, do not forget to check out my investing blog from the link in the description below. And yeah, this has been it for today. Hope to see you in the next video. Bye.